So what whole life insurance policy should you consider if you are looking at a huge amount of money going into a policy? When I say huge, we're talking high six figures or seven figures per year. This is quite often when it comes to cash value life insurance planning. Often people think or hear, hey, is high cash value life insurance only for the elite, the ultra wealthy, and these big corporations? And the answer is no if a policy is designed properly. But in this video, what we are going to cover is a product that is really exclusive to individuals pumping a ton of money into whole life insurance policies. It falls under the category of a high early cash value product, which is, in our last video, we covered a basic high early cash value policy. This is a bit different with respect to how a high early cash value policy works. Remember in the last video where about 80% of the premium shows up in cash value right off the bat? And really how the company does that is that they are not overcharging you, the policyholder, right off the bat. They're spreading those expenses out. So if you were to compare a high early cash value policy to a different policy that's available, you'll see it lag over the long haul in terms of actual cash value performance. Whereas with this guy, not really the case. We get the strong upfront cash value and strong long-term results. They do spread the expense out and it lags slightly compared to other policies, but it's not enough to make or break a decision. People look at it and say, okay, that's attractive. But again, we do have to qualify for this particular product. So how this policy works is, number one, it is really geared, or the market for it is individuals that are allocating a lot of money into policies, whether they're doing that with their own cash flow, premium financing, corporations, some small businesses. You'll see a lot of corporations take these policies out for a number of their executives. It's kind of the name of the product, Executive Strategies Whole Life. Here's what I want to mention here. With respect to the base premium requirement, the minimum requirement, if one individual is considering a policy, is $100,000 per year. So that's not base premium piece alone, the 100K base. So it does not include PUAs. PUAs would be in addition to that. That right there will disqualify a lot of people in itself. Because if I'm paying a total of $100,000 per year, that's my maximum payment, which is a lot of money going into a whole life insurance policy. I could take a hybrid product, for example, or a limited pay, set a $10,000 base premium and juice the thing. This way I'm only committed to 10K and can really maximize the cash value and have very, very similar results. This guy's different, where the minimum base premium requirement is $100,000. I will add, if you own a business, whether it's a small business or a large corporation, and you're looking at this policy for a number of executives, then the minimum base premium is $50,000 per individual, which is a lot. So it is really geared, the specific market for this type of product is corporations and higher net worth individuals. So how it actually works, when we take the base premium piece, because going back to the fundamentals, where you can direct money, premium or the PUA rider, what happens? Premium dollars is typically what everyone does not want because they don't show up in cash value right off the bat. Check this out. You'll see about 95%, both on a guaranteed and non-guaranteed basis, immediately in the first year alone. So that's based on the base premium, what credits to cash value. A death benefit will be purchased based on that as well. And then in addition to that, you can elect to add funds into PUAs, further accelerating the cash value growth. Very, very attractive. And the PUA rider will get you some death benefit. Let's make that $ small. So let's look at some examples. We're going to do things a little different in this video. First, we're going to look at a basic Executive Strategies whole life insurance product. But then we're going to look at an actual case study, which we actually had to get approved. It was a special exception, which anyone can get. If the circumstances are correct, companies will approve it. But we'll look at that after the basics. So beginning with a basic illustration, we've got a 40-year-old individual. Where's your money going? Well, here we have a basic design. Here's your base premium. Check this guy out. $100,000 per year, all base premium. That's the minimum requirement. The software actually warned you of that, saying, hey, for the minimum premium for this case is $100,000. If it's lower than that, it will not be approved for sale. So they make that very clear. But as we look at this guy, what do you notice? So this is a 100% base premium example. Therefore, this column only reflects the base premium, so we can use it in this case. 100K in, there's your cash value based on the minimum guarantee. In the first year, $95,000. Here's your real money column, net cash value. In the first year, these two match each other. That's attractive, no matter how you slice it. Now, what's also very interesting about this, here's your annual payment, 100K per year. To the right of that are your total payments over time. There's your break even. And this is based on the present dividend, nothing fancy, no indexing, nothing like that. So with a 100% base premium product, we're breaking even year 8. Now, what happens when you start to get creative and really juice the policy? Let's take a look. So what we're going to look at here is an individual who is younger than me. When he looked at this policy, he's younger than me in general. I'm extremely impressed by his work ethic and how fast he moves in business. And he's humble about it as well, which always goes a very long way. In this case, he's considering 7 figures going into a policy, looking at a number of options. Here we've got a true 7-pay. So what that means is max funding up to the MEC limit for 7 years, interested in maximum cash value. He said, okay, how do I maximize this thing based on the limits that are made available with about 7 figures per year going in, right around $1 million, a little bit more in this case. So knowing that the minimum premium, a lot of corporations do this, just the planning and strategies might be different, but the minimum premium here is what? $100,000, as low as we can possibly go with this particular type of product. Then what do we see? Paid up additions rider, our PUA rider. Literally 10x'd it as much as we can. Now, here's what I want to add here. Of that PUA rider, we've got a pretty fat term insurance rider here. This is a cheap way to raise the MEC limit. With that said, he is very young. Here's the cost for the term rider. Just about $8,000 initially, and the cost will go down each year as well. Guardian's nice because it has that flexibility. We can bounce payments up and down over time. With that said, often when working with these type of cases, people don't need the flexibility, or it's a premium finance case where it's being financed, so they don't need that flexibility. It's not as much of a conversation point sometimes. So as we look at this guy, what do we notice? $1 million goes in. What's your cash value right off the bat? I'm sorry, 1.1 million goes in. There's your cash value, just over $1 million initially. Death benefit is really solved for a MEC limit. We overinflated it slightly here, but here's just a true 7-pay. 1.1 going in. Here's your payments. Breaking even between years 4 and 5. The old product, before the 7702 change, would break even between years 2 and 3 because we had a lower PUA rider fee. But even with that said, the new design, here you go, looks fantastic. And we did look at options with payments constantly going in after 7 years, as that's very possible. But here we just looked at, okay, how do I maximize the internal rate of return based on the dividend option only? So here we go. So no payments thereafter. Look at this thing go. So IRR, a lot of times I know people will ask, hey, how do you get the internal rates of return? What formula you use? Some people say that we're making it up on Excel. It's like, no, it's right here in the illustration. Here's the same policy, internal rate of return. This is the average IRR. IRR, net cash value. You will notice the IRR, the average, not the annual, the average will no longer be negative when I have more money in cash value than what I paid in. So in this case, I've paid in 4.4. Year 4, I've got 4.372. Next year, 5.5. I have 5.6, another $100,000. That's where I've got the positive internal rate of return. Based on the company's present dividend interest rate, tops out a little over 4.3%. So it gets close to 4.4%. Then let's also look at an index strategy. Here is an example, exact same policy. You can see with the death benefit, there's the 1.1, funds it for 7 years. After that, pays just the minimum premium. A lot of people like to practice this strategy. So I just want to zip down here. Here we go. Check this guy out. How's that IRR look? So this is 100% just a safe asset play, meaning here's money that is in safe accounts. I can move over to a cash value life insurance policy. The safety is great. He likes that index feature. He may or may not use it, can flip back and forth over time, but here's a great area to position money. It's liquid if I ever need or want to access it. The tax-free feature, especially when you're in a higher tax bracket, is very attractive, to say the least. And then also you've got a big death benefit from an estate planning standpoint, which always has a benefit when you're looking at these kinds of numbers. But internal rate of return just continues to increase. But it is a good product to be aware of. I'll add this too. There's been many times where we look at that product. Some people select it, some people don't. They like the traditional product. When they measure the internal rate of return, they get a little bit more long-term. Depends on the individual. It's not uncommon to see it all. Someone say, you know what? I'm not going to use the money up front, so I don't need to have 95% of it. I'm okay with 90% or 85% because I'm not going to need it. I value that little bit stronger long-term performance. My point there is, if you're in the business, show them the options. If you're a consumer, make sure you see the options. That is really what gives anyone assurance that you're going to pick the right option because they are all presented. If they're not, and you find out about this after the fact, that's where issues can pop up. So hope you enjoyed this one. I always like talking about these type of corporate-based policies because frankly, it's my background. Before I got into business for myself, I was a back office nerd just modeling these things, and I love the illustration software. So I hope you enjoyed this one. Please hit the like button, subscribe for more if you did, and as always, I hope this helps. Talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.